You need to get over the concern about being right every single time. You need to put aside also the idea of perfection, because you're not going to have it perfect. You're not going to get in perfectly. You're not going to get out perfectly. You're not going to have the perfect amount of contracts. You're not going to have, the perfect asset. In other words, you may be trading the Nasdaq and the E-mini S&P has a little bit better run and delivers a little bit more. Highly unlikely, but vice versa. You get what I'm saying. So you're always going to find reasons to be wrong. Embrace imperfection. Embrace the idea that you don't have to know everything. You don't have to be right, okay? Being right is not equivalent to being profitable. Between this high here, in the midpoint of this low to high, I'm expecting down close candles. That would equate to a bearish bias. It doesn't mean that I can't take a long entry. It just means that if I do take a long entry intraday, I'm going to do it with far less leverage. And if I see a setup that's bearish, I'll use or consider using, not always, but I'll consider using my maximum risk, which is 4.5%. But I'd like to see trades that I feel comfortable with 3.5%. And until we get down to this low and underneath it, that means it's likely to reverse or consolidate. And we have a retracement back in. So once it starts doing this and it's hanging around equilibrium, it gets very difficult, even for me, to determine a bias. So what does that mean? No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble, and like a surgical strike. You take your handles or your points that you're trying to get out of the marketplace and then run. You don't try to overstay your welcome. The market trades below the old low. Trades below it, rallies above, but does it trade above this short-term high yet? No. Then it goes down once more, below the old low, but not below this low here. Then it turns and goes higher. What did I see in this chart that allowed me to go long in here? What did I see? Nothing. I didn't see anything in this particular chart. I saw it in the S&P. Before I leave this chart, I want you to think about how that high was around 14,620, and it was this candle here I got out at. That one right there. Then it retraced a little bit, and then went higher, pressed into the ultimate longer term high, sweeping the buy side there. Let's take a look at the S&P. S&P, similar situation here. High, that's the best case scenario for the day. This high here, that's where it could reach for. 830, we're right here. What's the point of expecting it to go above that? Not much. We want to see some kind of a protraction. So the market, yes, it went above that short-term high and then went lower than that low, yes. But watch what happens. It trades below it, comes back up, and look at all the volatility and the sloppiness inside this area here. Then the market starts to rally. So the draw on liquidity is going to be here. It took out sell side here. So let's look inside this price action and see if there's any details that would lead to a run into that, we'll call it the 44.95 level. Okay. So the 2-minute chart, this is what I was using. The market trades below the old low, as we see here. I apologize, the screenshot. I wish I wouldn't have had these things on it, but you can look at your 2-minute chart on TradingView and you'll see this a little bit more clear. I apologize. But this low candle, it's high. Then we have one candle up. The next candle's low. There's your fair value gap. That's the run in here. So we have displacement low and displacement high. Is there a market structure shift bullish? Yes. It trades up above it. And then you look for the fair value gap. Is there one in here? No. Anything in here? No. How about here? No, it's closed in. But this move down here. But we have this. So we trade down into it here. At 1036, that candle forms. That's a long in S&P. Now, compare that with this fair value gap in the S&P We traded below the old low. We took sell side out. We have a shift in market structure on the S&P. These averages tend to move in tandem. So that means they generally move in the same direction. So I'm looking at the Dow, even though you don't see me trading it, I'm looking at it. I'm also looking at the S&P, even though I'm favoring the Nasdaq because its volatility and its movement is more than the S&P today. But at 1036, let's go back up to the Nasdaq. We don't see any fair value gap in there, do we? Nope. But we start to see Nasdaq turning. So I went in long in close proximity to this order block. Okay, I went in at 14,505. So if we're expecting a fair value gap to be a launching point for the S&P, and these markets generally move in tandem, I don't need the fair value gap in the Nasdaq because I'm utilizing the S&P as my indicator. What did I just say? The word that should not be spoken. Indicators. Yeah, even though I don't have them plastered all over my charts like graffiti, you can see the candlesticks in my charts. You can see the logic. You can see how the markets run for liquidity. There's nothing hiding or masquerading price. You can see it. It's clear. You need that. You need to be able to read the story of price and not the story of indicators. So the logic is that S&P low in here was trading down into an old fair value gap over here in its price swing. But there is no fair value gap in the Nasdaq. See that? Now let's go back down into the S&P. Even my own paid memberships learning something tonight. I should have charged money for this one. Oh, ICT. Fair value gap. Trade down into it there. That's a long for S&P. But I don't want to trade the S&P. So I'm going to use the timing of that candle for my long entry on Nasdaq. Trading what's not in the chart. Hint, hint. Nudge, nudge. So market rallies. And it trades into that short-term high that was seen on, let's go back up, right here. So again, just roughing it around that 44.96, 44.90, we'll just call it 96, 44.96. And that would be right in here, bang. Hits it, sweeps it, accumulates some more, and then rallies even higher, taking out that longer-term old high. All right? What gave me the confidence that this was turning here? Well, let's take a look at the three averages together. If you look at how the market's trading low here on the Dow, this top chart is the Dow futures. The Nasdaq futures is in the middle, and the S&P is at the lower end here. So it's Dow, Nasdaq, S&P. During that decline in the Nasdaq and the S&P, look what the Dow's doing. It's saying, nah, I'm going to sit this one out, boys. It's not willing to make that lower low. Where Nasdaq did, S&P did. When you see that right there, and here's an important thing, you anticipated already. You're not looking for this. This is what some of my students, when they come into my mentorship, they see this pattern, they think, oh, it's diverging, so that means it's going to go the other direction. No. This is something that confirms an idea that you had already established before price does what it's doing real time. What does that mean? You're already looking for a reason to go higher. So that means you're looking at an old low. Does it trade below the old low? Okay. Does it have a shift in market structure that's bullish? Yes, we saw that in the S&P, but we did not see it in Nasdaq. No evidence whatsoever was in Nasdaq this morning with what I'm teaching you. But it was, listen, it was in the S&P. And no, I don't trade the Dow, but I utilize it like an indicator. It's not plastered all over my chart. I'm referring to it because I have multiple monitors. I'm looking at my screens. I have a screen that shows charts like this. So I'm looking at the relationship of all three averages stacked over top of one another. And if I'm looking at a period of time and an area in price action that maybe is going under accumulation for long positions, this is what I'm looking for. I'm looking for that little fingerprint of the algorithm. What this is indicating is the Dow's unwilling to go lower than that low. That tips off individuals that are looking for cracks in correlation. Okay, correlation would be They are moving lower here, here, and here. But that correlation where they move in tandem together cracks here at a very important time, right when the Nasdaq and the S&P are trading below its old low. I get questioned all the time, ICT, how do you know it's going to be a fake break below an old low and rally higher, or a fake break above an old high and go lower, which is what I dub a turtle soup. Now, that's not the same pattern that is taught in Linda Raschke and Larry Connor's book, Street Smarts, which is actually an excellent book. I have my own interpretation of that, which is very easy. It's simple. There isn't I'm not going to teach their pattern. Go buy their book and support the authors. But the idea is I'm looking for runs above old highs to set up a short position if I have the opposite of this condition here, where maybe the Dow didn't make a higher high, where the S&P and Nasdaq did make a higher high. By itself, it doesn't mean anything. So many students over the years have simply went in there and said, oh, this is magic. I'm going to go just do that. And I unwillingly did the same thing when I first started observing it. I'm like, well, I don't need to do anything else. I just look for this. And it didn't work out well. Okay, I blew accounts. Yes, I'm not ashamed to say it. In the 90s, I blew accounts doing this very thing here, just looking for these divergences. And then I later learned that I have to have some kind of narrative as to why this would even form. And to be honest with you, I don't personally need to see this because I know what I'm looking for. I already know that it's going to create this divergence at the times I'm trying to buy. But as a developing student, you may not have that experience, and there's nothing wrong with that. And you may be trading longer than me. Maybe you've been trading 31 years, There's nothing wrong with that. Maybe you don't need this either. But for a developing student, someone that doesn't have a affinity for reading price action naked and not using indicators, these are the best indicators you're ever going to have. You don't need moving averages. You don't need stochastic. You don't need Fibonacci. You don't need any of that stuff. Okay, you don't need it. The only reason why I'm pulling a fib up is to show you where the midpoint is. Have you noticed that? We haven't even talked about optimal trade entry. None of that stuff. I've stripped this down to the chrome. And it's beautiful, is it not? It's easy. It's so simple. It better be easy enough for my daughter to do it. Because if you can't do this one, I don't have anything for her. But nonetheless, I want you to think about how this pattern confirms the accumulation of long positions. This is the Dow in relationship to the Nasdaq. Notice that this market here on the Dow was able to make a higher high, whereas the Nasdaq was unwilling to make that higher high. Now I teach that as SMT. Six Sister is similar but not the same as SMT. There are conditions with a trending market where the Six Sister opportunity will see a move that hasn't transpired yet on one asset or correlated market, meeting or exceeding an old high or an old low. And I'll explain what I mean by that. Because this high here was taken out by this high on Dow, it would be reasonable to expect in a symmetrical market that the Nasdaq itself would go up there and hit that too. But look closer. What do you see? There's a failure here. So this high is higher than this one, whereas this high is higher. We have a very specific time of day, and we're also looking at this divergence, and we're going to take a look at the ES. The ES was able to make a higher high here as well, but it didn't make that higher high there. Notice that? So if I take this idea and show you on the Dow, we penetrated this high here. Let's add some lipstick to it. So you have the high broken here at 8 a.m. Higher high. Both this high and this high was exceeded with the Dow. On the ES, we made a higher high here, but we did not make the higher high here. at 8 o'clock. So this high was lower than this one. If we look at the Nasdaq, we had that lower high across both. This high didn't get penetrated, this high didn't get penetrated, and we're diverging. But now here's where the six sister approach occurs and how to use it within a consolidating market. If this one's weak, we're going to wait for this one to drop down into a deep discount. That being this low to this high. Let's run a fib on it. So from this low up to this high, here is your optimal trade entry levels here, and here's equilibrium. So it trades down below it here and then goes into the order block, which is these consecutive down close candles, the black ones, and then we have a fair value gap here. So there's your discount. If you look at this high here and this high here, that's buy side resting here, and I don't need it to go all the way up to here to find a profitable trade. So I can be buying in this fair value gap inside of the order block, below equilibrium, inside of optimal trade entry, these two respective levels here, 62 and 79% on the fib. So I'm going to look to buy in a discount, and you can see that is the case here, right there. And I'll hover over top of it, you can see. Okay, I accumulated the position inside the order block, inside the fair value gap, inside of the deep discount, aiming for the buy side above this high here and the buy side above here, and I'll put one right between the two of them, here, here, and there. Okay, so that price run here, I did not need it to go up to here, even though it was likely to do so. I got out above here because I knew that once it takes out this buy side, it could want to rejoin what has been seen in the ES and the Dow. Now let's go back to those. At these highs here, at this specific high, look how much more it dropped off on ES and the Dow. So yes, they all three dropped. Nasdaq did not have the ability to get back above this old high, whereas the ES was, the Dow was. The Dow was also able to get above its high here at 230. The previous trading session, ES was not willing to do so. But so one of two highs were taken out on ES. Two of both highs were taken out on the Dow. Neither high was taken out on Nasdaq. That's the sixth sister, and we're in consolidation. So that means it's likely to drop down to a discount and then rally to go back above the buy side, whereas Dow was able to do so. I don't need ES to do so, and it's already went lower anyway. So using the sixth sister in a consolidation market means we're looking for the one that failed to make a higher high or lower low, which is like typical SMT. But the sixth sister approach or concept that I'm using is that it's going to try to do it later on. And you want to put your focus on the weakest one because, well, the Bible says so. First one now shall later be last. First one now shall later be last. This one couldn't even muster up enough momentum to climb higher, whereas the ES did get a little bit higher, but the Nasdaq ramped all the way back up into the buy side here.